Pleasure to be here, guys. Nice to meet you all. Pardon? We've got a South African in the house. Exactly. Let me just see how to move this without the mouse. Okay, so swimmer, South African. Started a profession. Yeah, you know, I don't know what I was going to. I want to talk to you guys. Guideline for our conversation, but I want to open this up to you guys to stop me at any point in time. There's something I may be saying that I'm taking. Try to share. Okay. I grew up in South Africa. Rebbe story. And so forth. South Africa. At the time, whether I should go back. Bottom line of the matter is, thank to him, back to South Africa, and university. Myself. I was now focused on especially you start South Africa, my degree probably I interested in. Think of the CEOs on the Johannesburg Stock Exchange are accountant. So when I tell people here I'm an accountant, they say, "Oh, so you do taxes?" I don't do tax. I stay far away from taxes, and I give it to people who are specialists. Working for Grant Thornton, I worked for them. I did many varying types of company audits, from small to large to public to not public. Eventually, I took charge of the training program for all the Southern African offices of Grant Thornton, training all the levels of staff, from partners down to the junior beginners. My wife is from Crown Heights. She was living in South Africa. She got a gun to her head, and it's just time for us to leave. So we came here in 2004, right? So it's almost going to be 17 years, yeah. Oh, that I was, yeah, I was in university, and I finished, I don't know, 8, 9, 8, yeah, I was 4, 5 years of working once I finished. I was at Grant Thornton for 5 years. I progressed very quickly there. That I was, when I went to find out about an opportunity to transfer to New York, he said to me, the managing partner told me I was a couple of months away from making partner, but I came here, I went to Grant Thornton here, and I learned the American system, which is very different, but I got great experience. It was at a time that Sarbanes-Oxley was being rolled out. SOX was a new ruling by the government with additional controls over companies, especially after all the fraud that took place in the early 2000s. They wanted to implement Sarbanes-Oxley. I was actually responsible for the implementation of SOX for Grant Thornton clients in New York. Eventually, I left there. I got involved in a technology business. I was there. Sarbanes-Oxley. They had to report in a certain way. It was all about internal controls. It was all about, who controlled the money, where there was segregation of duties, etc., and so forth. We had extensive checklists. We had to do a lot of work on Sarbanes-Oxley to sign off on it and say that they're compliant. So after I got involved in the technology business, it was less finance, more operational. But again, like Rabbi already said, money, follow the money, that's where it all is. Then I got involved in a private equity fund, a small fund with family members. We got involved in investing in a multitude of small businesses. It was mainly through relationships. Probably at that point, yeah, it's a while ago. We invested in a bunch of different businesses, technology businesses to children's shoes, etc., and real estate. I loved what I was doing. I always love what I do, but I was getting a little antsy because I need to be like super busy. Met the CEO of this company called Soho Studio Tile Bar. I was introduced to him through a friend. He met me. He said, "I need somebody like you." Smallish company out of Brooklyn. We had a warehouse in Brooklyn, and 5 years later, we are 400 people, growing at 30-40% a year. We have a 300,000 square foot facility in New Jersey right now, which we have actually outgrown, and we are having some issues getting orders. Baruch Hashem, things are fantastic, but we have our logistical issues of getting in too many orders and not getting them out the door. So it's a good problem to have. I was involved in May of 2019. I brought in private equity partners into the business. If any of you know, private equity is typically investors who come in, they want control of your company, and then they want to grow you and sell you at a multiple 2 or 3 years later. So when we brought them in, we actually negotiated. The CEO went to see a Rav and spoke to a Rav about what he should do, and the Rav said, "Don't give up control." So when I negotiated with the private equity guys, we did a 50-50 deal, something that they'd never done before. So we retain control over the business and all the decisions to us, and they are fabulous partners because they bring depth of knowledge and depth of contact to the table. So they've helped us grow. However, they made my life, I wouldn't say a misery, but the reporting requirements they needed, the new bank needed, helped finance the deal, and I can go into the details of how that typical deal is structured. Everyone requires numbers. Everyone requires accountability. And, that's what we're here to talk about, what it means, financial statements, what it means to be, what's accounting, right? We all hear about accountants, CPAs, but ultimately it's an accounting. Erev Yom Kippur, Rosh Hashanah, you're doing an accounting of your pros and cons, the scales, right? Same thing with a business. A business, the only way to truly understand a business is by looking at the financials and understanding the numbers and the accounting. So what I found in my experience is, and where I see that relationship flourish, is the CEO of the business that I'm involved with. He's an entrepreneur par excellence. He's a visionary. He wants to run at 1,000 miles, not wants to, he runs at 1,000 miles an hour. I have to keep up with him. But at the same time, he's learned a lot over the years how things work. The reporting that we built from dashboard to, I've got a 70-page Excel file, which I built that I literally just bring in 2 sheets of data and everything else populates. I change the dates and the reporting is all done. So, to me, I mean, you put me in a room with Excel and I can stay there for the rest of my life. I love Excel. And not to say that you need to, that the first mistake people think or people make is, oh, I've got all my financial information in Excel. No, Excel is not an accounting program. An accounting program starts from a low level like QuickBooks all the way up to an SAP system where it's a complex system which incorporates financials, it incorporates operating metrics, it incorporates a lot of different facets. So accounting, what accounting means to me as the CFO is I need to know what's going on in the company. I need to know how to predict. I need to know how to forecast. I need to know how to budget. I need to know what to tell the banks. And I'm on phone calls with our partners every single Monday. They want a flash report on last week's sales margins, product categories, people, working movement in working capital, budget to actual comparisons, and I could bore you for hours. So again, I don't know your levels and your experience. So, you know, just I'll ask you a couple of questions shortly, and hopefully it will just give me a little bit of an indication of where we're at. Why am I talking tonight? Well, firstly, I love sharing what I know. And I don't know a lot. And I know you think that I know a lot. I still have tons to learn, right? Because that's the nature of the world. The world's changing. The dynamics of finance change. The dynamics of business change. And you never stop learning, no matter how old you are. So for me, this is a great opportunity to, if I can give you something and you can get something out of this, and I'm available to any of you after this, 100%. If I can share my information, if I can help people over the years, I've helped people build business plans for their business, help them establish their financial information, their financial structures, advise them on those sort of things. So I love doing that because it's about giving, to me, it's about giving back. So that's why I'm here tonight, but I'm also here to emphasize the importance of numbers. You know, we all live and we all need to pay our bills. Maybe some of you are married, some of you are not married, and money comes and goes a lot quicker than we imagine. And we turn around and we say, where's this money? What's going on? And that's why accounting is so important. We'll go through financial reporting, which I think is the key focus here. What is financial reporting? What are the principles of financial reporting? I'll never forget, I didn't do accounting in high school. And like I said to you, my degree started off right away with accounting. My first class, I'm sitting in accounting, and the guy is talking about debits and credit. And I'm like, what is it? What is that? It's like a table and chair, debit and credit. And I had to try and get my head around the concept, debit and a credit. And eventually, it just clicks, it makes sense. And maybe why I am a good accountant, despite the fact that I'm not that nerdy accountant who walks around with pens, you know, and I'm very straight-laced. I'm actually on the contrary. What I love about accounting is everything bad. One side and the other side always has to be in equilibrium. You know, we talk about a scale and making sure that scale of mitzvahs are various, right? No, in accounting, these are always level. If they're not level, you get problems. Everything has to reconcile. Like when I got to the company and I started doing a deep dive, and I said to the controller, where's the reconciliation? And I was told, oh, we don't have one. No. We're going to get one. We're going to figure out what goes into those accounts and how things work. Now, we work in a very complex system where there's a lot of moving parts. So it also depends on your industry. You know, if, you know, business 101 is you buy a widget for $1, you sell it for $2, you pocket $1. Today's day and age, things are very different. There can be manufacturing, there can be technology, there can be service businesses, there can be, wholesale businesses and so forth. Our business is made up of a multitude of channels. We have Soho Studio is a wholesale company. So we sell tiles, mosaics, you know, wall and floor products and so forth. On our wholesale business, we sell into about 1,200 retail stores around the country. So we've got these beautiful display towers with our products on. We've got about 4,000 SKUs. We present them in the most magnificent way that people can touch and feel the tile and turn it around and see the description and pictures and everything about the product. And then hopefully they place an order from us. So then we've got our Tile Bar brand, which sells direct to consumer. You can go on the website, you guys can purchase product. We have a huge sampling program. So if you go online, you order samples, you'll get a beautiful box of samples. But we've got shtick. We'll send a Marks and Ikes in every box that goes out. A Marks and Ikes candy. Why? The philosophy of the CEO is if you give something to somebody without them asking for it, they're going to feel an accountability to give you something back. But we're also about quality. People can see, touch, and feel the tile, and their interaction with us, we try and make superb. So that's direct to consumer on tilebar.com. We have a whole A&D division, which is to designers, architects, contractors, builders, and so forth to get discounted pricing. And then we sell on affiliate channels, Home Depot, Wayfair, and the like. We try not focus on those channels, even though they do exceptionally well, because ultimately we spend a fortune on our brand. The amount of money we spend on PPC and Google and driving traffic, we have 30,000 people a day on our website. So we are driving traffic. We want the conversion. We want people to engage with us. And we want the experience to be fantastic. So gave you a little bit of that reporting, that background. And I guess before I start off with financial reporting, maybe I'll quickly go around the room for just a couple of seconds. You can just say, you know, your name and what you're doing at present, what experience you have. Are you working, not working, studying, what line of work you're in? So it just gives me a little bit of an idea of who you are and what you're doing. So let's start off with the right side of the room. Okay. Shlomo, good friend.
And like learn about balance.
You buy from an Amazon seller. Oh, you sell. Okay. Through what sort of channel? Oh, wholesale. Okay. 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 So the one thing, I don't know, there's a book called Marketology from Warren Buffett. He's an old school investor, but I love what he has to share. You know, when in his spare time, he's not looking at Facebook and Instagram and Twitter and CHYE, you know, whatever, CHYE Live and whatever those things are. He's got spare time. He reads financial statements. So for those of you that know or don't know, public companies are required to issue financial statements. They're public, so they issue a 10K and a 10Q. 10K is the yearly and a 10Q is the quarterly. There's also other issuances of things that they have to put out to the public domain because they're a public company held by private individuals. Private companies, obviously a lot more difficult to get their financial statements unless you're a real investor. Sign NDAs, you sign not confidentiality agreements, just like when we got involved with our private equity guys. There's a lot of, you know, paperwork involved before they could access our financials, and then there's a whole due diligence process whereby they analyze everything from start to finish. Not just about the numbers, it's also about your concentration of your customer base, right? So if you're an Amazon seller, for example, they would look at that potentially as a riskier business because you're dependent on Amazon. Amazon can turn you on and off. You know, the barrier to entry in the Amazon space is different. So you have to make sure that you've got a secure supply chain. Tells a wonderful story. It's not about the numbers, just about the numbers, because me as an accountant, I know that you can not play with numbers. I hope this, you know, it's not go. You can use numbers to the benefit of the company in certain manners, right? Within the bounds of God. Ultimately, we follow generally accepted accounting principles. That's GAAP, right? So GAAP requires a certain way for reporting consistency. Because if everybody reported however they wanted, it would be just one big jungle of a mess. So GAAP gives you some form of structure saying you can do. When I say the financials can be played around with, what I mean more is, how do you want to use your cash? If you've got cash, do you want to use your cash to buy something, or do you want to use somebody else's cash? Right? If you buy something, do you want to show it as a loss to the business, or do you want to show it as, oh, I own an asset? It doesn't have a direct impact on the earning capability. And we will discuss those concepts about assets, liabilities, income. So first off, there's the balance sheet, there's the profit and loss, and there's the cash flow. So the profit and loss is as a how much money are we making? Sold this amount of products, this is what it costs us to run. Again, buy something for $1. Ultimately, money is something very big concept in accounting is something called cash versus accrual. Okay, what that means is cash basis accounting is just money in, money out. Accrual based accounting is not necessarily tied to cash. I get a bill from my landlord and I put it in rent, but I haven't paid it. So I'm accruing for it on profit and loss and showing it as an expense, but I haven't paid for it. But if I was doing cash-based accounting, then the rent won't show up on my profit and loss statement. So that's why generally accepted accounting practice is that it's accrual-based accounting. So whenever you're looking at financial statements, always about like profit and loss. It's over a period of time, 12 months. Last 12 months, trading last 12 months. An investor were looking at a business and you looked at their prior killing it. To look at them from, you know, July, August, and September, perhaps, because they're a cyclical business. So bankers, investors, general, when you're looking at financial statements, it's always about periods of months. However, that represents owns or owns. What assets you have or what somebody else. This is what we know something. More own than own those assets. So balance sheet is a representation of your financial health. The profit and loss is a representation of your earning capacity, your profitability, and how you can earn and what you can earn. And the cash flow is literally a combination of the two. Cash flow, and we'll go into cash flow from operations, cash flow from investments. This is my cash generation. December 31st, we have inventory. Details. All three of these together tell the story of the business. So, you know, I'm going to run through this fairly quickly so we can delve into some of the details, because like I said, I could be here for forever. But financial, so we'll touch on the forms of organizations, who the users and uses of financial information is, the different business activities that exist, which I mentioned, financing, investing, and operation, and how we communicate with users, like I mentioned to you, through financial reporting. So you've got different forms of organizations. Again, like you guys have already said to me, you are working for companies, but I'm sure you all have ambitions yourself to grow your own business. And what I will tell any entrepreneur, start like a guy, start like a year, you're going to end not well. What do I mean by that? What I mean is when you're starting a business venture and you shake hands and say, okay, you're going to do this and I'm going to do this. I'm going to put in 10,000. Corporation, you have proper documents, you write up proper documents, and you spend the time and money up front because it's only going to pay off in the long term, right? And that's where you'll get advice from accountants, tax accountants, and those number crunchers, and attorneys on what the best form of an organization is, because depending on the form of the organization and what you envision for the business, it will dictate how you want to form an entity. Tax ramifications. Where do the profits flow? How do you get money out of the business? What's the best protection? If you're in real estate, you'll notice, for any of you that are in real estate, every real estate project is owned by its own LLC. Why? Because an LLC has a protection. against the assets and liabilities of potentially the other owners. So the forms of organization allow you to have certain protection or distribution of so forth. And again, I'm not going to go into those finite details. Obviously, there's the users of financial information. All of you mentioned here that you're in the warehouse, and you students, and you manage your students. You know, you're in construction, you're managing your projects, etc. But in a bigger business like ours, we've got finances of our company, because it's not just open to the general employee. Human resources needs to know how much money they can spend on people. Finance and management, marketing needs to know how to spend the money so that there's good returns. Then you've got external users. The tax man, you know, we had to register in 40 states for sales tax purposes because of the Wayfair decision in the Supreme Court. Now suddenly we're being audited from states because, you know, you're now on their radar. So there's tax authorities, there's bankers, there's customers, there's creditors. You want to purchase merchandise, people are only going to sell to you if you've got credit. They're only going to sell to you if you've got good references, or at least give you credit. So get those credit, come in the driver's seat. I'm negotiating now with one of our big suppliers. Right, the more we buy, the project comes. I mean, the product comes. Now, as those products become cheaper, our margin and investors. So, you know, obviously, questions asked by different people is, can we afford the people that we have in the company, human resources? How much should our product be, and how much can we spend on advertising, marketing? What product lines should we are most profitable? Like, we have a big issue in our warehouse. We've got 300,000 square feet. We stack product 8 stack high. And we are moving, you can't even imagine how many packages, you know, take 4 reams of paper. That's how many orders we move a day, right? But there's the logistics, people picking the orders from different locations, and there's certain things that management have to understand. What's moving, what lines are moving the best? Put them at the front of the well, I'm the one that has it because I know it's product. But it translates into operations as well. Why? Because the operational people have to understand which products are selling, and know how to store them. The products out based on demand and supply. We don't want to have too much of a product, because ultimately, if you've got product, well, I mean, people are in the warehouse, what it costs to get a product out the door. Right now, they just sit back. You've got a lot of things from it. This is all another. Dude, just says, we take it. Point in time, well, how much phone
how do we pay service? What's the average value? How much
labor costs and time go into it, and all those metrics, although they financially measure, into operation. So, I'll refer to the performance financial indicators, operational indicators, in a warehouse, right? That's why you have WMS systems, warehouse management systems, because when you want to get one thing to be thinking the most efficient of this technology, but again, it's all fit in ERP and a system, and it all fits together. And then obviously we need to know how much money do we have to spend on growth initiatives, how much can we pay our stockholders, the investors, the bank, and the like. You know, you got investors like we have who are asking questions like, how come your EBITDA is not X? Where's the cash? In a year. How much money are you spending on investment? Understand showing you growth doesn't mean that it's sustainable growth. So there has to be a story. Financials tell a story and businesses tell a story. And I can stand to, you know, the one thing that I joked with a good friend of mine who's built a very big furniture business. And, you know, there's Fortune magazine, there's Forbes magazine. And a lot of them may say, well, we tried this, didn't work, and so we you know, we pivoted into this area. A lot of muzzle in not muzzle, but you also have to make your muzzle responsible. So we, as part of we have a budget, we have 1,200 budgets, and 5 years. That direction of focus will run off in different directions and take that to our own. Aware, right? Your CEOs or people or your buyers don't tell you what they're doing. Suddenly, containers that come in that day. It has to be communication. And it starts from financial, operational, marketing, so, you know, and then again, creditors and banks are going to say, can you pay your interest? Can you pay your debt? We have covenants with our banks. Every bank has different covenants. You have to have certain ratios that I have to be responsible for every single month and provide them with a breakdown of those ratios. Right. So ultimately, so that's it. So you're talking about in a bigger business. So we have this. I hate throwing people. Drives me crazy. People say, no, we need people. So I've been in this business for 5 years. We've added one extra person in the accounting department, but the company has quadrupled and got far more sophisticated, and we went through an acquisition, and we have more sophisticated reporting. Why? Because again, I love Excel, but I also know that there are tools out there to help you with these things, as opposed to throwing people at a problem. We have that exact problem right now. We have too many orders. We're limited by the number of freight we can get out every day. We cannot get right now more than 500 freight out a day, because we are limited by the dock doors. We've got only a wrapper that can wrap 1 pallet a minute, right? So you would think that you could wrap thousands of pallets. Yes, we can, but where do we put them? We need space. And when we wrap them, these are tiles. This is heavy stuff. They have to be wrapped and packed and strapped in a certain way. There's the safety and security. There's getting the truck, loading them in. You can only put 20 in a container. Weight. Every business has, quotation. So we could throw, yes, we're throwing people at the problem, but we've also brought on the right person, a guy who has 30 years of experience, who comes from an immense background of managing millions of square feet of warehouse space, and he is working with us to better manage the warehouse. We're also now currently looking at a West Coast warehouse, and that's how we grow the business. So people come to me as the CFO, and they often ask me that question: can we hire X amount of people in to do this? Now, I know what we have in the bank. I don't want to just say yes, and I don't want to say no. But there's always that fine balance of saying, ensuring people are justifying it and then held accountable for it. You want the people? No problem. Then you want to see your output comes back to you. For example, revenue per person. So if a company makes $100 million and they've got 1,000 people, what's their revenue per person? $10,000 a person, right? So your KPI, you hire more people. Now the warehouse has X amount of people, but your throughput hasn't increased, or your damages are higher than normal, or your returns are higher than That's why we have a budget, because we're predicting the future. We're predicting what it's going to look like. But I've never ever seen a forecast that doesn't look amazing. I've never ever seen somebody tell me or show me a business plan that doesn't look like it's going to make money. So, whereas in our business, we budget. So now I've got a metric and I've got a mechanism to now start end up at the end of the year, given the current thing, current prior month, and then it helps me make it start from bottom up and top down. I don't know what it takes to happen. I used to in the warehouses somewhat. We've got hundreds of people in the warehouse, running 2 shifts from morning to night. It's constant. Techniques, those sort of techniques, and give my input. I have good relying on the ground. They know that tell you, but I'm going to hold you. So, you know, there's certain concepts. We'll go through financial statements and so forth. Again, we are going to for sure run out of time because I'm pretty good at that. So, yes. So the main thing. So, one of the most important accounting definitions and concepts is assets equals liabilities plus net worth, which is equity. The reason why that always equals, and if any of you did math in school or you did algebra, the right sides and left sides always have to equal. So if you want to understand what net worth is, how do you get net worth by itself? You move the L to the other side. How do you move the L to the other side? You have to minus L from the one side and minus it from the other side so that it equals, right? So in this case, your net worth would represent your assets less your liabilities. And that's the fundamentals of accounting. Assets equals liabilities plus equity and net worth. And you'll see that on the balance sheet. It's all about value creation. Why do people go into business? They want to make money. Equity is where the money is, right? Because equity is put into the business. It shows me our profits are made lost. That's what my company is. Similar concepts in finance. You know, if any of you have got a mortgage, right? What's the value of your house? Okay, the market. I put in, I bought a house for $1 million, $200,000. It's $1 million, right? Now, the market takes value. But that's the value of my liability to the value of my back to the fundamental accounting principle, right? We've discussed income versus cash, and then I just want to talk to you about, most of you probably never learned about debit and detail. Green versus yellow, the double-sided principle. Where there's a debit, there's a credit. There always has to be a balance. And what does that mean, right? A green is an increase and a yellow is a decrease. And we will see, and that's fundamentally the debits and credits. And I'll show you how that works in just a quick example before we jump into actual financial statements. We've got source of funds. Use of funds. Say loans, your source of funds, right? When you get money, your source of funds represents the yellow. Remember on the previous slide, I said the yellow is a decrease, but I'll explain to you that shortly. As soon as you borrow money from somebody, you owe them money. Borrow money. 30,000 and 30,000 as a loan. Now, let's say we have an equity partner that came in, or I'm putting in equity into a business that I'm starting. Same thing. I took $20,000 of my money and I put it in the bank. The source of funds is my equity, which is a liability to the company. And the bank now has an additional 20,000. So what's the ultimate? What does the financial statement look like of the business on day one? You've got your source of funds being the loan of 30,000, the equity of 20,000, and $50,000. Now we start operating the business. So the first thing we may do is buy inventory. So when you buy inventory, what happens? You're using the funds. So when you use funds, it's in green. You're using up those funds, right? And what are you using them for? You're going to buy inventory and equipment worth 10,000 and 5,000 respectively. Okay? How did you pay for it? You used funds. Where was the source of the funds? Now taken out money. Whereas your assets, after this transaction, what does your balance sheet look like? Your balance sheet looks like this. Now compare the two. This side you have your use of funds and your funds. Now you've got use of funds and funds, which is assets. Your source of funds stay the same. $450,000. However, you use them in a different manner. You bought inventory for 10,000, you bought 5,000, like I said, always need to be balanced. And that's what your balance sheet would represent. Your assets less your liability equals your liabilities plus your equity. Same accounting concept all over again. What's the equity? The equity is what the investor would put in. Is like I said with a house and a mortgage, you have equity in when you put $200,000 as a deposit, that's your what's that? Right? Ultimately, the point here is I'm trying to explain the debit and credit, which if we had more time and if we wanted to get that level of detail of understanding the pluses and minuses, the sources and the use of funds, this is just a quick depiction of where you're getting money from, how you're using it, and how it all balances. Exactly, because it's in relation to your using the funds, the use of the funds is for this, but your source of funds is a reduction in bank. When you look at the bigger picture, the bank's still in green but it's gone down from 50 to 35. And that's exactly, it's a reduction of an asset because you use the funds for the purchase of equipment and inventory. So like I said, we've got the profit and loss, the balance sheet and cash flow, which I explained to you. Very important, The profit and loss is a measurement of the earnings over a period of time, right? Many people will throw out words like top line earnings. I'll explain those key concepts. Right? But ultimately, your profit and loss is explain to you. EBITDA stands for earnings before interest tax, right? So what that represents is the earning potential of the business before you have to pay taxes. Money that's owed, right? So very quickly here, I had a small quick example of a lemonade stand. I don't think it's important to really discuss, but you know, very simply, I'll run through it in 2 seconds. You sold 100 cups of lemonade at $1 each, right? Some of your expenses, the water, the concentrate, $3, you made $80. Right? You made $80 in profit. You had no more money than actually your pocket. You pay your tax. And that's where you accrue for tax. You know you made the money, right? Next one is same thing. Somebody didn't pay us $1. That guy down the block said, "Oh, I'm dying of thirst. Please just give it to me. I'll bring you $1." Right? So what happened is I did make $80 on my profit and loss, but what was my cash in my pockets? $79. But I've got an asset. That guy owes me $1. Very simplistically. So net working capital, I'll go into. Net working capital is basically the difference between current assets and current liabilities. So here's my colors again, income and expenses. Income, right, is the source of the funds. They're coming from my sales. How am I using those funds? By paying salaries, by buying products, and so forth. Right? Again, that's the use of funds versus the source of funds. So when you look at a profit and loss, so you've got revenue, let's say, you sold product A for $1,500 for the year, product B $1,000. You have revenue of $2,500. Your cost of goods sold, right, is $500 for product A and $350 for product B. That's how much it cost me to buy those products, and I sold them for $1,500 and $1,000. So what does the profit and loss statement look like on the right side? $2,500 incoming. It cost us $850. We made $1,650 in profit. Now, let's look at the impact on the bank, because now all the financial basically what happens is cash in the bank goes up $500. What's left? Equity. Your profit. So we just now took a P&L and converted it into how it impacts the balance sheet, because otherwise you can't. As you use one resource, it comes somewhere else. But well, that's something financial.
now forget. Why do you need January to close? You need to know voices of vendors December. The things that you have to do to close. But when you as of the day, or the end 12 months ended, as of
So again, I just wanted to very quickly show you the same balance sheet that I showed you on the previous slide, the before and the after. Once they made the sale, all that you saw on the previous slide, they have in the bank, loan, and now suddenly afterwards, the bank account $5,000 down from 10,000 to 9150 because you sold 850 worth of inventory. Okay, your equipment stayed the same. Now you look at where they're money and how it all the loan changed. You still got a $30,000 loan, and you still got your $20,000 of equity that you owe the person who put equity into the business. But what did change? The income, which is part of the equity section on the balance sheet. And that's your $1,650. And that's, again, look at the bottom, it nicely balances, 51,650. Because it always has to balance.
So the bottom right is the balance.
Well, the bottom, yes, yes, the bottom
the left side is what?
is the profit and loss.
Profit and loss.
Exactly.
Loss.
And then the balance sheet.
And what?
Oh, the income statement is the profit and loss. Sorry, sometimes it's, I know when I came from South Africa, we use a lot of different. So it's profit and loss, income statement, you know, balance sheet is a balance sheet, but profit and loss and income statement are interchangeable. So now let's look at the income statement. It's made up of revenue, expenses, you've got your costs, and you've got your cost versus accrual concept, which we've touched on. We've got EBITDA, which I've highlighted there, which is earnings before income tax and amortization. Then you've got your net income. Your net income is what remains available for investment. If you go to the slide here, what's the value of this company now? If you were to look at this company, it's now 21,650. That's how much the equity, the net worth of the company is, right? Because if you took the assets and you took the liabilities, and you sold your assets, paid off your liabilities, what would you be left with? Your 21,650. So ultimately, your net income is what's available from operation to reinvest in the business. Okay. And then we will look at and talk about certain ratios. I love ratios because how do you compare one company to another company? Especially hotel.
margin. What products have high margins than others? So sell it quantity. Let's say you can sell something that costs you
$1,000, you can sell it for $10,000. That's where ratios are very important. You want to look at EBITDA as a percentage of various things. Your margin contribution. So let's say, for example, in our business, showrooms. Right? So, owns. I have a P&L because ultimately our trades all these divisions reporting, like I said to Wazoo, I know profitability, but I've got a frame.
said to you, just tired of the 25. So while we're in the fashion game, we have to be very careful with what we buy because people want certain items. New York, California, Miami are very different product to our. And this comes down to understanding more important. I given them previous to this. I've given them show you very quickly. Okay. Okay. So this actually just took Amazon. Right? It's a public company. You can go search online and you can type in any public company and search for the 10K. Right? I have one on my computer. I don't know how to move screens, but I can show you soon. A 10K. We're a small company. That make up a material of your business. So different businesses make different things. You know, like technology and content. UPS, I mean, Amazon is huge, but technology and content for a pharmaceutical company, not we they are. So business specifics. In our business, we don't have a separate for content. So we invest in technology. Say, thousands of yes, what you want to look at is like I said to you previously, you've got your product sales, right? You've got businesses that are service industry. Take somebody like, oh, I could magnify. Okay. So
Hey, McKinsey Consulting. Self-service, or you have contact with somebody, how do you account for it? Say I there's a lot of complexities in a manufacturing business. You need to know cost accounting, because if you're taking a sheet of metal, and how you account for things and how the business operates will be. Here, very simply, for Amazon, it's very simple. It's the net sales, net service sales, and then the cost of their sales. So cost of sales for them, just remember how Amazon operates. When they see you doing well on a product, guess what they're going to do? Right? You guys know. But essentially, the cost of their sales is what costs went into delivering that product to the consumer. When we brought in the private equity guys, I had arguments with them how I looked at cost of goods and how they looked at cost of goods. They wanted certain things included, and I thought otherwise, and we came to a medium. Cost of goods is what does it cost you to get to the customer? Very broad. Your net income, and then you've got your earnings per share, and that's how you'll evaluate how much money a company is making. Your balance sheet, we've spoken about most of these topics. You've got your current versus non-current, very important. What's short-term versus long-term? We've spoken about all the other things. The balance sheet here will look like something like this. Okay? They've got cash and cash equivalents. 2016, 19 million, now they've got 20 million. Nice. They have $1 million extra. That doesn't mean they made $1 million. That might be just timing issues. Nothing to assume from that, but you can at least see if they've got enough cash to do certain things. They've got security. No, this is all in million. So it's 20. You're missing 6 zeros. When you present financial statements, when the numbers are, yes, when the numbers become too big, it says the millions, right? It becomes too big. Sorry, they carry 16. Well, I'll refer to it. They $16,000, let's say, of inventory that they have on hand. They went from 11,000. Now think to yourself, they went up $5 million of inventory. If I was an investor, how old is it? Can I sell it? It says consolidated balance sheet of travels and funds. December 1st, 2007. Whatever they have I was an auditor. Make sure they say 1,000 this represents that 20 million cash.
That's what
and you calculate average turnover on inventory, the ratio. I won't bore you with the ratio, you can look it up, but basically it's opening inventory plus closing inventory divided by 2.
That will show you days of inventory, days of right? The line that is accounts receivable. When from now people are property and equipment, assets, just general assets, and obviously the word net, because when you buy a, what do you buy? A forklift. The minute you start using a forklift, assets, that's why it says net.
Because your property and your equipment depreciates. It depreciates for GAAP and it depreciates for tax purposes, right? Because you can write that off for tax purposes. Well, people in real estate never pay taxes because they claim the depreciation on a building, and so there's a separate line item there called goodwill. That would be exactly. Here it happens to be goodwill. We have on our balance sheet a value of our trademark. Because when we did the deal with the private equity guys, we obviously got more valued assets and liabilities. So where's the difference? Well, there's a value in the trademark. We have to bring in an outside company to give us a valuation on what the trademark's worth. And that would sit as an intangible asset. Other assets, that's the top part of the balance sheet. That's the asset side of the balance sheet. Don't forget the assets. Much is the total assets of the company Amazon in 2007, $31 million. How much is the total liability plus equity? $131 million. They equal. Now let's go through what this section is. Liability stakeholders. Liability, like I said, always starts from short term to long term. What's the most short-term liability you would have as a company? What I owe the guy I bought the merchandise from. What I bought, I owe my accounts payable. Right? Then you've got anything else I owe that's not a payable per se. So it could be an accrual for rent. There could be, every business has different type of accrual. Now, again, as you see, Amazon has a lot of movement has taken place on their balance sheet from year to year. Some is good, some is bad, right? And you'd have to analyze those movements as to why. And that's why there's like the long-term debt. To me, I look at this and I'm saying, whoa, holy cow. It went from 7.6 million to $24 million. They borrowed another
18 months, 18 million, $17 million worth of money. Really? Assets. Yeah, a lot of the cash that we borrowed went to inventory, 5 million in inventory, right? And potentially to fund the difference in working capital between my AP and my AR. But we would see that clearer on the cash flow. Inventory? Yeah. Right now, I'm assuming it, but you'll see on the cash flow. How did it get from 11 to 15? You need a cash. Where did you get the cash from? Operations or debt, like we saw earlier. And then the bottom part of this equity structure is very complicated. You know, additional paying capital, and I want to show you something that's very important. Every year, your profit and loss statement is zero. We take earnings. Go back a few slides. Look at the income statement at the bottom. 33, my math's a little off, but you see the 3,000 there on the right-hand column, the net income. The net income, that's what the business made. January 1st, 2018, zero. And that's how the two intermingle, and that's why they talk to each other. So part of the funding analyzing financial statements. The cash flow statement, very quickly, is the timing differences between cash and expenses and the balance sheet movements. Because the cash is used to buy inventory. Keep it simple. Here, I know it's complicated. As assets go up, cash goes down. It's negative cash because you're buying inventory. As your liabilities go down, your cash goes down. Because you're paying, using your cash to reduce the liabilities. And that is exactly what a cash flow statement does. It shows what is the cash at the beginning of the year? How much did the business make? That number again. These all tie together. You've got a lot of accounting. It all works. 333 comes from the net income. That's from the business. Remember we're talking about cash flow. Cash flow is actual cash. Because what you're reconciling is the top line, cash, at the beginning of the period, and the bottom line says cash at the end of the period. Remember when we looked at the balance sheet, they had 19 million at the beginning of the year and 20 at the end. 19 at the beginning, 20 at the end. Well, now, let's try to see what they're thinking.
made 3 million profit. Where did that 3 million come from? The income statement, the profit and loss from selling product. All the other movements are either non-cash movements or they are movements in working capital. Down 35.82 over the year, right? Accounts receivable, sorry, not went down. It's a negative because it was a cash out. Remember I showed you on the balance sheet, inventory actually went up. In order to get more inventory, what do you need to do? What's a negative? Accounts receivable went up. More people owed us money. And also, show the profit of 3 million, but we actually you're missing that one exact. Pardon? It's part of the 3,000. As an auditor, very simply, I'll take their AR, their accounts receivable, see what. What happens is you've got accounts receivable of 1,000. Excellent, good question. So now, how do I get it out of my balance sheet? I was sitting on my balance sheet. I made a mistake. I accrued bonuses. I need to catch up.
auditor asked me, when we on the balance current liability. Oh, well, I guess I'll run bonus the 2020 because it shows profitability. So, profit one, profit and loss is going to have $1 million worth of bonus. That liability of $1 million of bonus happens later. So, over because I made too much money. I'm sorry, that I put much money into it. That extra one go back and sell. When the visitor was
Because you have to be.
as the monitor 12 months of telephone, 12 months of whatever. Sometimes the wrong 12 months. There's not 12 months of consistency. So let's think about December through November. Cash flow statement is broken up into operating and finance. So operating cash, maybe the balance sheet. The accounts payable moved by $7 million. What does it mean it moved? It went up. We owed $7 million more.
But as far as the cash flow statement,
That's actually positive. Purchase profit. Okay. Said, we saw on that there was an increase in assets. Proceeds from property and equipment. That detail, we made an acquisition, spent $13 million. Acquiring company. That's why they borrowed money. Don't you remember the loan on their books went to Wazoo?
because they wanted to fund it. That was back in 17, probably not. That was maybe, I'm not sure. I'm actually sort of looking at this fresh and new, like you. I didn't delve into it, but if I want to delve into it, Warren Buffett. Debt related and financial. Where did we borrow money from?
What principal repayment was there?
Were there loans that we took out, etc.? And we would see that movement here. Ultimately, when all comes together,
And balance sheet. And a lot of it. Well, if you go balance the cash flow balance.
Ratios is where you would, I've said, you want to look at year-over-year ratios, right? There's different ratios analysis, understanding movements. I could go crazy on liquidity, trend ratios, solvency ratios, operating ratios, profitability ratios. You've got AR turnover, you've got EBITDA as a percentage, you've got revenue per square foot. Square foot, are we generating revenue? Is it growing or shrinking? That's one of the metrics. So when I say square foot, I'm talking about
I look at square foot of top. It's very this makes it historic.
every industry is going to have its own unique ratios. So to compare one business to another, you need to be consistent with how you evaluate it. Revenue per employee. You want to be at a certain thing. If I've got 400 employees, I want to see next year I've got 400 employees. Solvency is how solvent the company is in terms of debt coverage. Is in many ways is leverage ratio. Oh. And I like me, I'm thinking, whoa, what am I going to say for an hour and a half? I can go. Trust me, I could go on forever. My practical steps to you guys, and I know it's very different, but it's understanding your numbers, understanding the trend. You have to understand your business. You have to understand your numbers. You have to control your cash. Cash is king. Right? And you've got lots of decisions to make in terms of, are we going to lend? Borrow money? In our business, hate us having cash. Why? It's not making money. It's not making money. No, not yet. They invested once. We have not needed more from them. If anything, we were going to already start paying them out. They've got a structure, but we don't want to be out of the cash because so it depends. They can't take a bigger share. When they buy a share, they bought the share. Right? Making more money. It's mine, but you know where the tax comes out of in most.
their customers, their us. Let's say
they're not going to cut the liability for the company. It's a company. It's very, I'm a shareholder. I own 50% and the company makes that's where yeah, that's where tax planning. I just put there, don't leave accounting behind. People get involved in businesses and then they turn to me a year later often and they say, oh my God, I don't know what's going on. And don't. Start off, no matter how small you are, start off with a QuickBooks, get an accountant, start off, there's easy ways to use accounting software. You've got all the information. Growth. Oh, two things left. Consult. Don't be afraid to ask. The best advice I got from you don't know everything. Don't be afraid to ask people who know more than you. You know what they say about, like the CEO always says, I'm only successful because half of what you you know where you're heading and you've got a strategic plan. 3 to 5 years. You know where you're heading. You've got goals. When you put them on paper, trust me. When you're sitting in your shower or don't put them on paper. And that's, I guess, very, very brief, very, very high level in a sense. There's but so much detail to know about. So, all the stuff, then you have to just, there's no real because it depends on your business. Start jotting. This is my idea. Oh, so, I mean, there's a lot of templates in terms of budgets. If you're starting a business, if you're an inventory-based business to start off with, again, if you're selling online, rather use a platform like not Magento, what's the other one? The platform that they will manage your inventory. Depends on how you sell it. Inventory is very complex because you've got high-value concepts and on it. Concept called LIFO, FIFO, weighted average. First in, first out. First out, last in, first out, and average. Meaning, some of the costs of running to actual statement. Item. On a title, sell a title with market people want $10. I sell it first. Follow first. It will impact taxes, profits, everything. There's a lot that impacts taxes because you can put accruals through, you can put, you know, what you buy, how you buy it, how you expense certain items. There's a lot of complexity. Well, your auditors depends your but ultimately then you'll be taxed the following year on the next sale. So you might be saving it this first year, but you're going to get the second year because the value's there. Like you said, absolutely. So the most important thing when you start a company
just hire
an accountant to help you understand, help you streamline it. There's a lot of people, little people who do bookkeeping. They're not CPAs, but they'll help you. Exceptionally well, and you want to bring in outside money, an investor's going to say, I need to see your information. Threat. Oh, I think, okay. If there's any more questions. Okay, so department. Absolutely. The data we compile now helps us make decisions for the next 3 years. Let's say we're collecting on a picker. How much he picks a day? Well, it's translatable because it's we use and I'll basically say, oh, we do it every day. I do it every day. I look at these numbers backwards and forth. Okay, maybe we should be sending out large format all by freight. Our freight data, but it has huge operational.
Yeah. Use that. Let's get that product. So that's purchasing.
Right? So the purchasing guy, based on our POs, we've got 3,000 open POs. Yeah. Based on those POs, everybody coming in, I'll make sure that has on it, on a day, on a day. As they move things around the and
time next comes in, this is coming in.
Work. So in that scenario, it's driven by at the end of the day, we have to pay for the goods. Last year we only had X amount of lines, then I need to talk to human resources. We're not just buying an iPhone and reselling it, where people already know the value of the iPhone. What do you need to do? Show them a picture of the iPhone? I can get you marketing materials on Google. It's the write-up. I look at reports every day of what orders we've lost. In the last couple of months, we've lost millions of dollars of orders because we just didn't have product. Now, no, we let the orders come in. Construction project, you don't have to but we will not allow somebody to order if we don't have a certain. Yep. It's a loss of an order, and then they cancel the order, and there's millions of dollars worth of lost orders that we could have had. For me, it's not even about the money. Much appreciated. Thank you. Thank you for the compliment.
I've written those notes from all my other.
I appreciate it. I love giving over what I can and helping.
What do you recommend? Books to read, YouTubers to watch. What do you recommend? So much out there. I'll tell you one thing for out of questions. I said, what do you want about financial? On what you want to do. Right? Does it make sense? Goes to school for you may not have. I know. Okay. No, I'm going to hire you.
Anytime. I'm glad.
So I'll tell you what, I want to learn more